Hello and welcome to Switzer Investing. I'm Peter Switzer. Thanks for joining me. And a lot of you have asked, why haven't I looked at EML payments given what's been happening to the company? So on a day when EML payments share price has risen about 12% after a run of horrors, including the resignation of the CEO, which didn't help the share price, we talked to a significant shareholder in Raymond Shamgar of Tamman Asset Management to see what the hell's going on with this company and is there any sort of light at the end of the tunnel. Then we talked to Raymond Chan of Morgans about the energy sector. Is it too late to buy energy stocks? And if so, what company should you buy if you supports the idea of sticking with energy? And then we talked to Paul Ryan of PropTrack. This is a division of REA Group. And we asked him, he's the chief economist there, we asked him what he thinks is going to happen to house prices going forward. Very insightful interview from an informed young bloke. So that's the program for the night. Let's go and kick off with Ron Shamgar of Tamman Asset Management. Ron, thanks for joining us.
Hey Peter,
yeah. So,
good to be back.
Same here, mate. Now, the reason why I wanted to get you on the show, and the last time I spoke to you, you talked about being a significant holder of EML shares, and after that, the company seemed to be on a nice rise after a real roller coaster ride ever since the coronavirus crash of the market. And I thought maybe you could talk people through why the company has struggled and what the outlook might be under the new CEO as well, because ultimately you have to make a decision about whether you're going to keep holding and trusting that this company can make a comeback. So why don't you talk us through why you like the company and why you increased your position until, I guess, recent developments?
Yeah, sure. Look, obviously EML Payments definitely been a bit of a volatile stock in the last few years. I think if you go back just to pre-COVID, end of 2019, they were really mostly a gift card in shopping malls business around the world, and they were doing okay. But then they announced the acquisition of the European business PFS, which really gave them, that more sexy, reloadable type payment cards that wasn't as cyclical and sort of dependent on retail sales as the gift cards. So the market really liked that. And then as we know, COVID hit, so that impacted EML significantly in terms of their gift card sales. People obviously weren't going out and shopping in malls. And eventually they actually, I think, the management and the board back then renegotiated the PFS acquisitions quite well. I think they bought it for a good price. And during 2020, as things recovered, the stock started to recover. But what happened was PFS money license, where they issue all these programs, was sitting in the UK, and the UK went through Brexit. So EML had to have an e-money license in Europe. And so they had to transition all the programs in Europe to another regulator, and they chose the Irish regulator, the CBI. And unfortunately, that was the biggest mistake that EML has made. Management has acknowledged it, because unfortunately, the Central Bank of Ireland has been a real handbrake on this business. They're not willing to let EML issue programs for a lot of these up and coming fintechs and all kinds of innovative, fintech businesses in Europe that, want to issue different programs, and they're making it very difficult for EML. And so as these programs went from UK to the CBI over late 2020, early 2021, and they were growing fast, the CBI suddenly realized, hang on, we've got these billions of dollars that are coming through us from this company, and we don't know exactly what's going on. So they really started to look into it, and they just decided that they're not willing to take any risk. And they issued this letter to EML. At the time, the CBI wasn't even aware that EML is a listed company. I think that's really what happened. And I think that the directors and management at the time did the right thing. As soon as they found out, they told the market. As we know, there is a class action against them, but they've really done nothing wrong here. Maybe you could argue that they're good at giving all the bad news, and then they're not very good at giving any good news. But that's a different story. So obviously that happened in May 2021 last year, and just before that they did do another acquisition of a company called Centennial, and they have an open banking business called NewerPay, and that gives them that sort of also future growth optionality in the open banking segment, which is fast growing but still in its early days. And then obviously we had the CBI issue in May, the stock plummeted, and since then, really over the last 12 months, they've been trying to appease the CBI through this remediation program, and obviously that put a limit or a ceiling on how much they can grow. And on top of that, they couldn't grow, but on top of that, they had to add a significant amount to their cost base, again, in terms of regulatory checks and so on that the CBI wanted. So when you can't grow your top line and your cost base goes up, we all know what happens, and your profit gets crunched. And so this is the downgrade that we've seen come through more recently, which saw the stock, fall from $2.50 to $1.50 or thereabout. And then, as we know, just before that, there was some takeover interest in the business by private equity Bain, and that fell through. And there has been some rumors recently of maybe some other approaches. Now, as we know, on Monday, Tom Cregan, which was really the face of EML, he's been the MD, the last 10 and a half years. He's taken this business from nothing to where it is today, which is a global business, profitable. And he decided to resign quite abruptly. And I think investors panicked for two reasons. One is obviously a lot of people backed him for many years, including us. And so some people just, capitulated and just gave up. And I think the other reason is usually when a CEO resigns abruptly and a company doesn't reaffirm guidance, investors always think the worst. And obviously investors believe that maybe the company is going to downgrade guidance again. Now we don't believe so. I think, you could look at it two ways. I mean, Tom leaving, I think it's good and bad. So if you look at the bad part, it's like I said, there's a bit of uncertainty in terms of the new CEO, Emma Shand. She joined the board in September last year. And so she's not a complete newbie, if you want to call it that. She kind of knows the business. Speaking to the company, I think she could be good, and the market might like her over time. She's obviously got experience, being, working with NASDAQ on the regulatory board. So that should be good with handling the CBI issue. Right. And also, I think more importantly, I think part of the reason that Tom left is that this is really a business that 60% of its revenues are coming from Europe, and sitting in Australia just doesn't work. And I think Tom just, didn't really want to travel as much to Europe. So she is going to be based in London, which is really good, I think, for EML, having the CEO, where most of the business is. And I also think that, you could argue that Tom, although he took this business to where it is, you could argue that some of those acquisitions maybe, weren't the right ones, because at the end of the day, you look at the share price, shareholders who haven't sold along the way haven't made much money. So you could argue that he didn't really deliver. Yeah. And so, having someone new come in is a positive.
Yeah. The Bank of Ireland decision clearly was something that, he has to take responsibility for, as well as the board. Wasn't there also some problem? Didn't the Bank of Ireland, Central Bank of Ireland, actually have some problem with some of the transactions of the company that they took over?
Yeah, no. So initially, the CBI claimed that there could be potential sort of AML, anti-money laundering, and fraud instances. But after going through the audit, they couldn't find anything really. So that's not the issue. It's really just the CBI not willing to regulate programs that involve fintechs and so on. So having this cap on their growth is the biggest issue. Now look, if you just look 2 weeks ago, EML announced sort of a stimulus program with Corius, which is essentially a Spanish version of like Australia Post. They're a big company. They announced a $300 million stimulus package, which they'll send out 500,000 of these digital debit cards issued by EML. So EML can obviously grow, and there's a big opportunity out there. But as they also announced in that contract announcement, is that pretty much that amount of money will sort of make them reach that ceiling, that limit on their growth with the CBI for the next 6 months. So in a way, it was also a negative bit of news because that CBI issue is still there.
It sounds like they've got more problems than Speed Gordon. And your position, are you going to remain a shareholder? Have you taken the opportunity to buy more at a lower price to dollar cost average your overall holding of EML?
Yeah, look, we bought more in the low 90s. I mean, if you look at it, it was $350 million market cap. We think they'll hit guidance of around mid-50s EBITDA. It doesn't have any net debt, so it's probably a net cash position. I think the CBI issue will be resolved. I do think they will eventually go to another regulator, like the Spanish one, for example. Once that issue is resolved, this is a really great growth business. It's profitable. Next year, it's going to probably make about $50 million in free cash, because a lot of these dormancy fees that they had this year won't convert to cash until next year. And we're talking about $15 million in dormancy fee revenue. So that will kick in next year. So next year will be an amazing cash generating year. And I think that we've been urging management and the board to announce a buyback ASAP, or even pay dividends, because I think that's really important to restore confidence to the stock. And also it just makes a lot of financial sense to buy back shares at these levels. And this could be another reason that Tom left. I think there was a disagreement at the board level about doing that. I think Tom was supportive of capital management, and knowing from speaking to the chairman, it seemed that he was quite reluctant to do it, and I don't know why.
Okay. Well, this is a controversial company, and if people want to invest in it, despite the fact that you think the outlook for next year is looking good, who knows what can happen with EML, but you got to keep your fingers crossed.
I would say one more thing.
Yeah.
I would add one more thing, is that as we know, interest rates are rising fast. Bank of Canada raised rates by 1% last night, and we know that the US will raise rates potentially by 1% next week. This is really beneficial for EML. So, I know they've got their issues, but they still manage a couple of $1 billion of clients' funds, and they get to keep those interest rates as they go up. So that will be a big contributor to profits in the next year or two. And I think that's a really good tailwind.
Yeah, and I noticed that the share price is up today about, Andre, can we whack it over? It's about 12%. Yeah, it's up about 12.3%. Did you drive that share price up today?
Yeah, we're not that powerful, but yeah, hopefully they reaffirm guidance and announce a buyback soon. So okay. That would be positive.
Okay, Ron, thanks for joining us. That's Ron Shamgar from Taman Asset Management. My next guest on the program is Raymond Chan from Morgans, and Raymond wants to talk about the outlook for energy and what's the best way of playing it. Good to see you, mate.
Yeah, good to see you, Peter. Thanks for invitation.
Yeah, fine. Now, before we get to energy, just talk about the overall market. What's the house view on what's likely to happen to the overall market in the second half of this year, which we're in now?
Yeah, the first hurdle most people would believe is the upcoming reporting season in just about 2 weeks' time. At the moment, we are seeing very little consent revision going into reporting season, which seems to be unusual, and that's why I think the number one risk at the moment is it looks like to be a earning downgrade cycle for the FY23 numbers. It appears to be too high still. The moment of truth will come out in about 2 weeks' time when the reporting seasons come out. With the reporting season, usually it's the best quality company. I don't know why, but it's usually the best quality company reported first, especially in the first 2 weeks, and then followed by the others. So I would keenly look at those results. So that's the first thing. However, if I take a step back, I always listen to our strategist view on the market in a sense of fair value. Okay. Given all the interest rate high, consensus numbers, all that, the fair value for the ASX 200 is still around 7,100 points. So based on where the ASX 200 is trading today, we are about 8% below the fair value. So if you ask me, how do I think about the market? I think the market is attractive, but it's not big bargain, because whenever we see a bargain in the market is, when we are over 10% discount from the fair value. But of course, the viewer may say, hey, your fair value could go down with the earning downgrade. Yes, there's some risk of that happening. But equally, the way we calculate our fair value is we are not only using the consensus earning number, but we're also using the discount rate. And we factor in quite an aggressive rate hike from the central bank. So our bond yield assumption already high. So any movement where the central bank become less hawkish will likely to benefit our fair value.
Okay, great. All right. So therefore, from where we are now, you wouldn't be surprised to see an 8% improvement in the index by year's end.
Yeah, exactly. And we try to explain fair value in the way that the fair value should be where the market value trade today. But of course, give it a year time, I don't see a big risk. We're going back to the 7,100 point, despite the fact that I know there's a lot of negative noise and concern about the market at the moment.
Okay, so let's go and talk about energy. We saw prices, they got over 120, didn't they? And I saw some bold forecasts. One guy had about $320 an ounce, and I'd like to know what he was smoking, but still, you think there's still value in the energy sector despite the fact it's been a good performing sector?
So I look at oil is in terms of the event. So if we all remember, going from 2021 to 2022, we are all talking about the reopening trade. So we are all going out from the COVID. We start to see people using more vehicle. We have a higher energy consumption. So at that moment, the market was expecting the demand for oil was going to outstrip the supply. Okay, then of course we have the Russian-Ukraine situation that suddenly put some of the supply away. Now, what changed the market from, I guess, especially in our market, from May onward, is an aggressive rate hike from the central bank that actually put the expectation of demand to a halt. So now actually the market thinking about increasing recession risk. Of course, whenever there's a recession, the demand for oil will collapse. But of course, we are talking about risk. So the expectation for demand on oil all of a sudden has gone down. However, if we purely look at the supply and demand of oil in the world, even with the lower demand, we are talking about 100 million barrels per day of demand. But the supply at the same time, some of the supply disappear from US and Russia. Our supply at the moment is also be 100 million barrels per day. So we are not going into a surplus in terms of supply. We are still pretty much balanced. However, because of the change of expectation from a very tight supply, excessive demand to a more balanced market, that's why we see the oil price collapse to $100 or below $100 earlier this week. Also, though, another thing in play at the moment is there has been a significant withdrawal of liquidity. What do I mean by that is I note from the first week of July, there's a 110 million barrel of oil got short. So what I mean by that is 1 day of oil supply was short in the market. So you can tell either be the hedge fund, they are shorting the oil, or they are simply selling the oil and repay their US dollars debt. So that is a lot of that is happening at the moment, and that also explains why the US dollar has been so strong.
Okay, so what's your overall view of the oil price for the year ahead, and then what stock do you like or dislike as a consequence?
Very good question. So enough bad news, let me talk about some good news. First of all, we think in longer term, the supply of oil will remain constrained. The reason is two key reasons for that. Number one, the US shale oil, after the two recent oil crash, one in 2016, the other in 2020, most of these US shale oil has disappeared. They no longer be able to get the finance that they want. That's the first thing. The second thing is the big oil company, they stop putting money into new project. Remember, with mining, you almost need 10 years to put a new project in place, to put new production in place. So when the market becomes more normal, the oil supply will remain pretty tight. So we're not too worried about the long-term outlook of oil price. And in terms of the stock pick, we still favor Santos. So obviously Santos is about to have their operational update next week, and they're going to have their financial result on the 17th of August, next month. One thing we like about Santos is 93% of the production is in gas and about 7% is in oil. So they are less directly exposed to the direct movement of oil price. Second of all, they successfully merged with Oil Search. I'm still keen to see how much synergy they can extract from Oil Search. One key point, of course, is Oil Search. While all of the operations are outside Sydney, they used to have a big head office in Sydney. That will shut down. That will save a lot of money already. And in terms of Santos, if they can extract more synergy, cost saving out of this Oil Search merger, I think that will show in upcoming result. Second of all, in terms of the balance sheet is pretty strong cash flow. Yes, they still have debt, but we expect the debt level will cut down quite significantly to almost close to net cash in about 2 years' time. So I think Santos will be the one that we like going into the reporting season.
Okay. Is there any other company that you'd put forward that you think looks pretty positive as well?
Well, inside energy, of course, we have a comparison with Woodside. Woodside certainly has improved the economy of scale and in terms of the operation and also cash flow post merger with the BHP petroleum business. So I think Woodside will also do well, despite the fact that in the portfolio whether you want to hold two energy stocks. So among two of them, we favor Santos a little bit better at this stage. So that's in the energy sector. But outside of energy sector, again, our whole thinking is going into the reporting season. What we like, we like the Lottery Corporation, TLC, a demerger from Tabcorp. We think the earning will meet expectation. On the flip side, we are less bullish on the banks. yes, we think rising interest rate will eventually benefit the banks, but lately I can see a very strong competition for term deposit. Some of the bank offer 1 year term deposit rate of 3.75%, which I think is pretty competitive. And there's a lot of this competition going on at the moment. Yeah, and so I feel much of this net interest margin improvement can be eaten away by a pretty heavy competition in the deposit money.
Okay. Raymond, thanks for joining us, mate.
Thank you for the time.
Well, joining me now is the economist from PropTrack, which is a division of REA Group, and they monitor what's going on in the property market. At the moment, a lot of people are worried about price falls, just to see how bad it's been. Paul, thanks for joining us.
Thank you very much for having me.
Give us an idea of what's happening to prices over the past month, and I guess even since the beginning of the year.
So we've seen, since the start of the year, we've seen price growth slow dramatically. Now we have seen prices start to fall, and prices have fallen particularly in places like Sydney and Melbourne, and in the ACT, where prices are the highest. And now those price falls can be typified by basically originally earlier in the year, it was on expectations of higher interest rates. And now we've seen price falls off the back of higher interest rates flowing into higher borrowing costs. So we've even seen kind of the darling market of Brisbane record its first very small fall in June as well.
It kind of makes me think that Brisbane's period of rising will end up being shorter than other states because they were behind, weren't they, for a while, Brisbane?
Yeah, absolutely. So, I mean, the context of these price falls is that they are very large at this point. So we're looking at price falls in Sydney and Melbourne so far are something like 1.5%, which is not very much. But it does signal that prices are on the way down. And if you look at places like Brisbane, Brisbane in particular benefited from all the things that we saw change in the pandemic in the housing market. So preference shifts towards larger homes, preference shifts towards affordable locations, and preference shifts towards lifestyle locations. And obviously Brisbane's known for having nice weather. So Brisbane has kind of ticked all of those boxes, and we've seen, even though we normally see people move from south to north to southeast Queensland, we've seen that kind of be turbocharged over the past 2 years. So we're kind of still quite bullish on Brisbane and southeast Queensland in general. We think those markets are likely to outperform, but that big weight of interest rate increases is affecting even markets like that.
Yeah, and so I guess you're arguing probably the falls in southeast Queensland will be less than other cities and states.
That's our expectation, yeah. And then the other kind of market that's benefited from this in particular has been regional markets, which are up 50% since the pandemic, and Adelaide increasingly. It kind of had a slow start to the kind of the boom that we saw across the country, but now it's still, the market's still recording solid growth. So 0.4% up in June. So
yeah, and is it because it has never been an overpriced market, a kind of a steady riser but not a boom riser? Does that help Adelaide?
Definitely. I think in all the time I've been following property, Adelaide's never been an exciting market to watch. So it's now that it's kind of topping the charts, or it's close to, over the past year, it's the second strongest performing market, is quite an exciting development for Adelaide. And I think traditionally Adelaide's been able to kind of build its way out of higher prices. And what's happened here is that people have finally recognized just how much value there is in Adelaide. And also there's just a greater proportion of people that are able to kind of use that work from home, remote flexibility to take advantage of locations with cheaper prices and bigger homes.
Yeah, I haven't come across this before, but someone like you may well have. I guess the coronavirus might have also made some people who were brought up in Adelaide and are working in Melbourne and Sydney think about going back home to have the support of the family and that sort of stuff. Are you seeing that kind of thing develop?
Absolutely. I, in fact, have a friend that I worked with in Sydney here who has just moved back to Adelaide for exactly those reasons and is now able to work remotely for his Sydney job. So that's definitely a factor we've seen supporting that market. Yeah,
okay. Now, George Thoronow, who's the chief economist at UBS, featured in a story in the Australian today where he actually talked about the sensitivity of the price falls were the most he's seen. Were you surprised, or do you agree with George?
So I think the price falls we've seen are concentrated in places like Sydney and Melbourne, where people tend to take out bigger mortgages relative to their incomes, is consistent there. So people who are competing for properties in those markets will be more concerned about interest rate increases than in other markets. So it kind of makes sense that at the moment, the big uncertainty in the market is what will happen, where will interest rates be at the end of the year, and where will interest rates be in the middle of next year. And there's a big divergence there between, say, major bank economists and the market, and there's kind of a 1 percentage point difference there, and that makes a big difference to potential buyers in Sydney and Melbourne. What's
your view? Who's going to be right in the long run? And be right, Paul. It's one thing to make a prediction.
I would love to be right.
It'd be good if you were.
Personally, not. Yeah.
Okay. But go for it.
It'd be very valuable if I could be right on this question. No, I've had a poor track record on the RBA's movements recently. But yeah, we still favour major bank forecasters that the cash rate will be somewhere like 2.25, 2.5% at the end of the year, rather than the market, which is expecting something like 3.5% at the end of the year. Now, the employment numbers today may change that. There was a very, very strong print. So we'll be going back to our books and reassessing that.
Yeah. Have you guys ever worked out like a model for linking, say, 1% rises in interest rates against falls in house prices? And if so, what are you expecting house prices to fall by then?
So borrowing capacity and housing prices tend to match pretty closely. So a 1 percentage point increase in the cash rate reduces borrowing capacity by about 10%. So that would be your kind of benchmark for how much prices are going to move. Of course, the other side of the ledger is that the RBA is raising rates because the labour market is performing well and the economy is performing well, and they expect wages growth to pick up. So wages growth they're expecting to come through the pipeline kind of in the second half of this year will mean people can borrow more, which offsets that increase in the cash rate, reducing borrowing capacity. So that's where we're how we're benchmarking our forecast for the market. So we're expecting something like 10 to 15% falls across the market over the next kind of year, 18 months.
Okay. But there are a couple of curveballs for your models, which I presume you wouldn't have had before, unless you've created brilliant models, Paul, and I guess you probably think you have. And that is the size of the savings that came out of COVID. You know, they kept mentioning $260 billion worth of savings locked away in a whole lot of lucky people's bank accounts, and also the size of buffers that people have built up when the interest rates fell and they kept paying. They're two immeasurable, well, hard things to work out, but they all seem to be good for actually working against a massive fall in house prices. True or false?
I agree. I mean, I think, we're starting to see articles about, are people going to start to struggle to repay mortgages? Are there going to be kind of, increases in arrears rates and things like that? And the underlying thing, or the thing that the biggest indicator that I would look at is the labour market. If people have jobs, people can continue to pay their mortgage. So we're not expecting big dramatic falls in housing prices because we're not seeing big dramatic falls in economic growth and the economy. So while people have less to spend, they can't borrow as much as they could because interest rates are higher. We still see a really strong amount of housing demand out there. There's still 50% more people on realestate.com.au seriously looking for homes than there were before the pandemic. So that demand has to go somewhere, but people can't spend as much as they could 6 months ago.
Yeah. Okay, I'm going to throw another couple of really hard questions at you. One is, how many people have home loans out there, and what percentage got those home loans over the last 2 years? And why I ask that question is, those people, though they borrowed at low interest rates, certainly paid high prices. Everybody else probably borrowed at high prices and all of a sudden enjoyed lower interest rates, and so they're not really facing negative equity and whatever. That's a really important issue for how bad the market could be and what kind of potential slowdown we have, because it's only a group of probably newer borrowers who really are going to feel the pressure, and they won't feel that pressure until probably it gets to 2.35% cash rate or something like that. Have you thought about that, Paul?
Yeah, we have. So the stylized facts here are that if you think about all households across Australia, you can roughly break them into thirds. So a third of households rent, a third of households own their house outright, don't have a mortgage, and a third of households have their mortgage. Now, looking at the recent data, something like a third of those people with mortgages took out those mortgages over the past couple of years. Now, there's a big increase in people refinancing because of those really sharp fixed rates that we saw throughout the pandemic. So it's a little higher than usual, I suspect. But yeah, absolutely. Those new borrowers, now some of those will be borrowers that refinance, so took advantage of new rates, but some of those will be people that bought for the first time or took out a large mortgage, and they're the ones that you might think are susceptible to these big increases in interest rates. And so now, firstly, most borrowers don't borrow their maximum. So if you use Commonwealth Bank's data, only 8% of people are close to their maximum when they take out a loan. And the other thing is the buffers built into loan serviceability. So when a lender assesses you on a mortgage, you have to be able to repay a mortgage now 2.5 percentage points higher than the current prevailing rate. Now we're getting up to that now as rates are up 1.25 percentage points. And obviously cost of living pressures are also eating into that cash buffer that some borrowers would have. But we're not really, so why we would worry about those recent borrowers the most, I don't think we're at a point yet where a lot of them will be in a concerning situation for their cash flow.
Okay, good answer, mate. Looks like you've been doing your homework. Well done. Paul, thanks for joining us.
Thank you. Fantastic. Thank you so much for having me.
And that's the show for tonight. Thanks for joining us. If there's a stock you want us to sort of inquire, we can do that. We can go chasing the CEO or a fund manager who's a pretty significant holder. Don't be afraid to ask us to do that, and we'll try and make it happen. Also go to switzerreport.com.au if you want to know more about other shares that some of our experts think are either in the buy zone or the sell zone. Thanks for joining us. See you on Monday.